The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
This is Denise Nostrom, CEO and founder of Diversified Financial Solutions. Now more than ever, investment advice is needed. Not just where best to invest your money, but why. Are you investing for your future retirement? Are you retired and looking to maximize your income? Are you maximizing your income and concerned with leaving money for your loved ones? Are you investing for your retirement at the same time saving for your children's education and at the same time saving to buy another home? Are the markets in line with your goals? Are your goals ever changing? Please contact me at 631-758-8691. That's 631-758-8691, or visit us at diversifiedfinancial.biz. For over 25 years, I have been helping individuals, families, and business owners navigate through all market conditions with only one goal in mind, my clients. Visit me at diversifiedfinancial.biz or call Denise Nostrom, founder of Diversified Financial Solutions, at 631-758-8691. That's 631-758-8691 for a conversation about my most important client, you. Hello, and thank you for tuning in and spending some time with me today. Yes, it is Friday again. Do you feel like the treadmill of life is going faster and faster and you cannot get off? If you feel that way, I do too. I don't know, maybe the time of the year, but wow, time is really flying by so very, very quickly. So you are listening to The Financial Chick Show, and I am The Financial Chick. My name is Denise Nostrom, the CEO and owner of Diversified Financial Solutions, a full-service independent financial planning firm located in Medford. I'm here live every Friday from 5:30 to 6 p.m. on 103.9 LI News Radio. Your Financial Chick is here to help you make better financial decisions and choices to improve your life and reduce your anxiety and stress about money. If you have any questions on anything we discuss on the show, you can check out my website at financialchickshow.com. We are also on Facebook and Instagram at Diversified Financial Solutions. So like our pages to get updates and see what is happening. So how is your week out there, whether you're watching on Facebook Live or you're listening in your car, maybe at home or maybe driving home from work? Since we were last together, which was last Friday, we have had daylight savings time and we turned the clocks back. So we allegedly got an extra hour of sleep. I say allegedly because I don't feel like I really did. I'm exhausted. Even the engineer, Mike, and I were talking, and he's like, he's exhausted. I'm exhausted. Everybody we talk to is just tired. So I don't know what's going on out there. But what doesn't help either is the days being so short and the darkness coming at about 5 p.m., which is very tiring and depressing, not to mention. But you know, again, to keep it positive, I'm here to keep positive. There's a lot of negative news out there, right? So we're working our way towards December 21st, which is when the winter solstice takes place, and that's when the days start getting longer. So that's a good thing. Although, albeit it's a slow, crawl to get the longer days, it's still like something to be positive about, right? I mean, you wouldn't really think about it like, as far as I went past Harrow's on the way here and they got all the Christmas trees up. People have their houses decorated. I mean, I'm saying December and it seems like a long time ago, away, but it really isn't. It's just going to be here before you know it. And Thanksgiving is less than 2 weeks away. Like, oh my gosh. But anyway, so some of you may have had the day off yesterday for Veterans Day. But I want to personally thank all of those that have served or are currently serving in the military to help us to preserve and protect our lives here in the United States of America. And as it has been said, we don't know them all, but we owe them all. So I definitely want to thank, I don't know if he's on here today, but Richie, a friend from high school, he's one of our military guys, and he's a veteran, so I want to thank him too. Good guys, good people. One of my heroes and one of my favorite people served in the Army, and that would be my person, or that person would be my grandpa, James McGibney. He had served in World War II, and he didn't see combat or anything, but he was in the Army and got to travel around the world, and he had some pretty cool stories. Fortunately, he passed quite young. He used to work in the subway system with the thorough, the MTA, and he got issues with his lungs, and so rest in peace, Grandpa. But again, thank him for serving as well. So last week I told you that we were going to discuss a little-known tax rule in the tax code, or a little-known rule in the tax code called 72T. So basically, what's happening lately a lot of people are looking to retire early, or with everything that happened with the pandemic, people are deciding to pull the plug a little bit earlier than maybe they would have thought about. One of the problems with that is that, you can't take Social Security at the earliest at 62. You can't touch your IRAs, your 401ks, your 403bs till 59 and a half. So you have this situation, unless you have monies outside of those retirement plans, what are you going to do for income? Unless you take on a part-time job or do something like that. But a lot of people that are looking to retire early just want to get out. So Rule 72T allows for penalty-free withdrawals from IRA accounts and other tax-advantaged retirement accounts like a 401k, 403b, deferred comp, et cetera, et cetera. It is issued, it's a rule by the IRS. And the rule allows account holders to benefit from their retirement savings before retirement age through early withdrawal without the otherwise required that 10% penalty that you would normally get taking money out before 59 and a half. The IRS still subjects the withdrawals to normal income taxes, so you'll still pay federal and you'll still pay state tax, and if you live in the boroughs, you'd pay your local taxes. But it gives you the opportunity to take money out of those accounts and bypass that penalty, which in many cases would be 10%, although that's from the IRAs. If you take it directly from your 401k, 403b, typically they withhold 20%. So it's a big chunk. So what Rule 72 basically, it refers to the code, as I said, 72T, which specifies that it gives the exceptions to the early withdrawal tax that allows IRA owners to withdraw funds from their retirement accounts before age 59 and a half, as long as certain qualifications known as SEPP regulations are met. So what does that mean? SEPP is substantially equal periodic payments. You need to take at least 5 equal payments to make this plan work. So the amount of payments depends on the owner's life expectancy as calculated through an IRS-approved method. And there's actually 3 methods that you can utilize with this. But you must adhere to those payments, and you have to have those scheduled for at least 5 years or until you reach age 59 and a half, whichever comes later. So, this is a way I kind of figured I'd talk about this. I had a client call. He, fireman, New York City Fire Department, and he retired a while ago. And he was in one of those situations where he has a tremendous amount of savings in his plans. He had 2 different plans and not a lot of money outside that. The retirement. So, as far as income, he doesn't really have the accessibility to derive income from those accounts at this point without penalties. So we're going to utilize this 72T rule to help him get some of that money out of the plan. Now, this doesn't work for everybody because, again, you're retiring early. When you think about life expectancy, you're going to be in retirement for quite some time. If the average 65-year-old, let's say 60-year-old retires, you have a life expectancy for about 85. So you're talking about 25 years in retirement that you're going to need to have income. So you don't want to kind of blow all the money early on and not have the money later on. So you have to really be careful with that. But calculations for payments under Rule 72T, there's actually 3. There's the amortization method, the minimum distribution, and the annuitization method. Now, I know that sounds like, another language at this point, but let's break that down to real language. The amortization method determines the yearly payment amounts by amortizing the balance or spreading out the balance of the IRA owner's account over single or joint life expectancy, meaning you take the payments either based on your life or a life of your spouse or your partner. This method develops the largest and most reasonable amount an individual can remove, and the amount is fixed annually, so you get the same amount every single year. The minimum distribution method takes a dividing factor from the IRS, again, same single or joint, and uses it to divide the retirement account's balance. This method is the opposite of the amortization method in that the annual early withdrawal payments are likely to vary from year to year. Not a lot, but they will vary. So the key difference is that this method versus the amortization method, it results in the minimum, meaning the lowest possible amount that can be withdrawn. So depending on what your goals are, it may be something that you're interested in. The last one is the annuity factor method. Now, in this one, just to kind of break it down, this will be kind of in between the amortization and the minimum distribution. It's going to fall somewhere in the middle. So let's take a look at a real-life example. Let's assume a 53-year-old woman has an IRA earning 1.5% annually with a balance of $250,000 and wants to withdraw some money, under 59 and a half. Using the amortization method, the woman would receive approximately $10,042 in yearly payments. In the second method, the minimum distribution, she would receive about $7,962. In the last method, the annuitization method, she would have $9,976. So 10, 7, say 8, and about a little under $10,000. So those would be the three things that you want to you'd want to take a look at. And depending on what your goals are, you may want to get the most amount. This gentleman I'm talking about wants to get the most amount. But if you want to get just a certain amount and know that you're not going to run out of money in retirement, you may want to do something, maybe that middle option. So I'm going to talk more I'm going to wrap up a little bit about the 72T, and then I have some other juicy stuff to talk about. But come back after the break, because we're getting to the break. I can't believe how quickly it goes, right? So this is your financial chick, Denise Nostrom. The company is Diversified Financial Solutions. I help you look for financial solutions when you feel like there are none. So feel free to contact my office at 631-758-8691. We're jumping to the commercial break, but jump back so we can talk more and give you more financial wisdom. Welcome back. This is Denise Nostrom, the Financial Chick. My company is in Medford, and you can reach me at 631-758-8691 or visit my website at financialchickshow.com. I am here to help you on your financial journey. Over the years, things change, and I'm here to help you navigate all of those changes. So, before the break, I was talking about a little known rule in the tax code called 72T. And what that enables people to do is take their retirement accounts out if they retire early or if there's other needs to get some income before they're 59 and a half, because before 59 and a half, you have a penalty of 10% on your IRAs, or in some cases 20%. They would withhold 20% if you have it directly taken out from your 401k, 403b, deferred comp, etc., all those qualified retirement plans. So we talked about the various reasons. So let's, and then we talked about the examples. But there are obviously some cautions to using 72T. So knowing that withdrawing money from a retirement account is really, really a last resort, a last financial resort. It's for the specific thing. Like, again, this is something I don't do often in my office, but there are people that, again, are retiring early, have the certain circumstances. Like I mentioned, this one gentleman built up tremendous amount of money in two plans, New York City Fire Department, and decided to jump out a bit early and just needed some money, so he wanted to access those accounts because he didn't really have any other money on the outside. But he has most of the lion's share of his money in his retirement account. So it made sense for him. And, in doing some planning, which is what I do at the office, some comprehensive planning. We don't do this willy-nilly. We really take a look at everything and look at the unintended consequences before we sign the forms. And, he should be in good shape based on his situation, and getting him to Social Security if we have that. That's another show for another day. But, all of the different things that he has going on, he should be able to roll with that. So, but this is why the IRS does have other exceptions for specific circumstances like disability and illness. So you can access money from IRAs or retirement accounts if you have certain qualifying events. But if you don't meet any of those criteria, then the Rule 72 can be used if you have exhausted all other avenues. It should not be used as an emergency fund strategy, just to make withdrawals, to maybe to put in a pool or something. That's not usually the best possible case scenario. So basically, the key takeaways here was that the Rule 72 will allow you to take a penalty-free early withdrawal from your IRA. But realize that it has to be done over 5 years, so it's either 5 years or 59 and a half, whatever's later. There are also other IRS exemptions that can be used for medical expenses, purchasing a home, and so on. Call me if you have questions. There are ways to get your monies out of your retirement accounts if need be. This is not the end-all be-all. This is really just for a specific purpose. And then finally, Rule 72 withdrawals should be considered, again, a last resort when all other options for reducing financial pressure, creditor negotiations if it's for a debt situation, maybe debt consolidation if it's for those purposes, bankruptcy, etc. All of those have to be exhausted before you go into those retirement accounts. But again, knowing that my job is to give you alternatives and options, and know that there always are options. You know, some people feel like, there's really nothing I can do. What am I going to do? But always give a call. Contact my office, go to my website, financialchickshow.com. And if you have specific things that you need to be addressed, let me know. And if there's a way to work it around, if you talk to my clients, that's my thing. I love figuring things out. That's, come to me with a problem and let's figure it out. So what I want to jump into now is, it was so funny because we were just talking about the engineer is going to be watching Star Wars. So it was just very coincidental in that I have an article that I read. It's called 6 Planning Points to Help You Live Long and Prosper. All right. Now, did we plan that? No, there's no way, right? But that's literally what's going on. So let's talk a little about this. So in the past 120 years, U.S. life expectancy has grown dramatically. There was a woman, Christine Benz. She's director of personal investments, and she explored this topic in a recent interview with Laura Carstensen, a psychologist and director of the Stanford Center on Longevity, on the podcast called The Long View. So since 1900, there has been a 68% increase in the average life expectancy from 47 years at birth to 78.9 years. At birth, 47 years, right, at birth, but to 78.9 years at birth in 2014. So 1900, we were living till 47. In 2014, we were living till 78.9. So while life expectancy has dipped since then to 77.8 years in the first half of 2020, likely due to the opioid crisis and COVID-19, the woman has mentioned that the long-term she's very optimistic about the view of longevity for the long term. So in her speech, she explained that since 1900, we have nearly doubled the life expectancy, which is more than has happened than in the last 2 millennia. But over the same time, she added, the fertility rate has dropped, so an age distribution that used to be shaped as a triangle with young people on the bottom is now a rectangle. So we don't have the youth that we used to. Our population is aging, but we're not replenishing. So in the interview, she mentioned that behavior that affects lifestyle as well as how wealth can help add to one's lifespan. But in the end, the healthy and the wealthy can't avoid the Grim Reaper. Obviously, we know death and taxes, right? Those are the things we always know we can count on. But here are some points that she made in the discussion. So I found this to be pretty interesting, and I wanted to share this with my listeners. So number 1 is to avoid the usual suspects and don't rely on your genes. So meaning that, yes, staying healthy includes not smoking and limiting alcohol, as well as getting exercise and having good genes. But she noted that we have learned that genes are not as important as we thought they were to life expectancy. The way we live our lives, lifestyles, and the way we live our lives and lifestyles contribute much more to how long we live. So it's really living a clean life, eating healthy. We always hear about it, but it's really important. And I'm going to have the woman that I had, Dr. Erica, back on my show on December 3rd to talk about health and wealth. Again, I just think it's such an important topic. So she's going to be back. So tune in that date. She's amazing. The second thing is have a purpose in life. One of the surprising contributors to life expectancy is having a purpose in life. Those people who feel like they matter to a cause or to other people, to their families, those people who have a real sense of strong purpose live longer than people that don't. Kind of makes sense, right? The people who say there's a reason for me being here are the ones who do better and live longer. So that's one of the things. We have our brunch this Sunday, so I'm excited, and I like doing that, and like enjoying people and getting people motivated and pumped up, so that's kind of a fun thing. Number 3, education has more impact on longevity than wealth. So this is interesting. People who have high levels of education are more likely to have higher incomes, so that makes sense. But she added that wealth helps those who get sick, but education seems to be a better predictor than money for staying healthy. But once you get sick, of course, as we know, as most of us do at some point, then wealth/income predicts better than education at that point, how quickly you will decline, because obviously money with better health care, etc. And then the fourth thing was perhaps it should be prosper and live long. Wealth has an impact, but there is a conflicting literature on how much money contributes to life expectancies. She said that studies show that once people get beyond the upper class, you don't see a lot of increase as you get into the very wealthy. Others say that for every 10,000 of annual income, people live longer. So those are the ones who really the ones that are at risk are the ones who live in an austere poverty. So that's something we always want to kind of help people out. And one of the people coming to the thing, Angels of Long Island, does a phenomenal job of doing that. COVID-19 has affected life expectancy. We've kind of known that, but not only that, it's been across the country, but most of the decline in the United States is being driven by subpopulations, mostly in the Appalachian regions, some southern parts of the country where we see high rates of drug use and poverty. And we also see higher rates of homicide and suicide. So there's a lot of dynamics going on. And finally, living longer means policy needs to keep up. So there's really no downside to living longer, but we need to point out that people need to change the way that they plan for retirement. They need to, hopefully they're going to work out Social Security and Medicare. That's a governmental issue. But we have to see, we have to really look at the practices that we do and put an emphasis on the fact that, we're not changing quick enough. As people are growing older quicker, we're not changing the policies. So I know that was a lot of information, but I read this article and I thought it was really, really a great article to share. And if there's anything here, again, that you're interested in, I can always send this to you or give you some more information. I know it's hard to kind of grasp all this as you're listening while driving or whatever the case may be, but always feel free to go to financialchickshow.com and we can send these articles to you. So we're at the end of the show. Thank you so much for tuning in today. I appreciate it, and have a wonderful weekend, and I look forward to being with you again next Friday.
Advisory services offered through Blackridge Asset Management, LLC, a registered investment advisor. Securities are offered through Peak Brokerage Services, LLC, member FINRA, SIPC. Blackridge Asset Management and Diversified Financial Solutions are separate and independent entities from Peak Brokerage Services.
The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.